Welcome to Money Talk. 5 reasons why a bank will always charge interest. In other words, 5 reasons why a bank cannot give interest free loans. I mean, who doesn't like free things? If banks were to give free loans, we will love it so much. I believe that even bankers themselves will love it because we all at one point or the other access loans. But can banks do that? Emphatic no, because if they try, they will not survive in business. I'm sure in your financial dealings, you have come across, high interest rate and you have complained at one point or the other. Why are interest rates sometimes so arbitrarily and ridiculously so high? What sort of considerations go into it? I'm sure you have wondered, around some of these things before. Are there justification for high interest rates? Or banks are simply insensitive and are interested in profiteering off their customers? Well, in this episode, I want you to join me as I take you through a journey to discover 5 of the factors. In fact, 5 of the compelling factors that inform interest rate fixing. Ready? Let's unpack. Number one is cost of funds. Cost of funds is defined as the price or interest that a bank pays in order to get money for its operations. Banks typically get money from two sources. Primarily, they get money from deposits and then also through borrowing. The deposit that banks receive is not for free. I'm not sure you will give your deposit to a bank for free. Banks pay interest on deposits. Remember also that banks are in competition for deposits. So, in order to entice you to give them more deposits, they have to pay attractive interest rates. Now, the interest rate that they pay on these deposits is part of their cost of funds or constitutes cost of funds. Now, the other source from which a bank gets money is through borrowing. And banks borrow from two sources. One is what we call interbank borrowing, and then also from central bank. What is interbank borrowing? Interbank borrowing is simply arrangements where banks or commercial banks borrow among themselves. Those who have excess liquidity or excess cash lend to those who have deficits. Now, that is not for free. Any bank that goes in to borrow pays interest, and that interest it pays in order to acquire that money to be able to fund its operations. It also forms part of the cost of funds. Now, after a bank has exhausted all the avenues of borrowing, it now finally resorts to the central bank for assistance. Remember, central banks are known as the lender of last resort. But central banks do not lend for free. They also have what we call policy rates, which is the rate at which central banks lend to commercial banks. So banks that go to central banks to borrow also pay interest by way of policy rates. So when you put all of these interests that a bank pays in order to acquire money, in order to acquire funds, to do its operations, to give out loans and for investments, is what we call cost of funds. Cost of funds. Now, the second reason why a bank is compelled to take interest on loans is what is known as opportunity cost. From basic economics, we know opportunity cost to be the foregone alternative. We live in a world of alternatives, a world of options. Funds available to a bank has alternative uses. Banks can put their money into all forms of investment to generate substantial amount of profit or interest. For example, there are investments such as treasury bills. Treasury bills are investments that are safe. They are risk-free investments, and banks can simply put their money there and go to sleep. When a loan is given, there is a probability that part of it will not be paid. Banks will have to spend some resources in order to recover. It comes at great cost. But if a bank invests in treasury bills, all that difficulties or all those difficulties can be avoided. There is also bonds and securities that banks can put their money into. We also have commodities trading, property investment. All these investment opportunities offer great interest and great profit. So if a bank decides to give you a loan, it technically means that it is losing out on all of these investment opportunities. All the income, all the profits, all the interest that could have been generated from these investment opportunities have to be foregone in order for the bank to be able to give you that loan. So technically, it will be losing out on all of these opportunities. Hence, its name, opportunity cost. The loss of the opportunity comes with cost to the bank. It is a loss. So opportunity cost can also be known as opportunity loss. And the bank will typically not sit down to lose, in that manner. And I'm not sure you would want your bank to continue to lose in this respect. And so for a bank to compensate, the bank has to be compensated for this kind of loss. And that is why it takes some interest on loans to be able to pay for part of these losses. The next reason why a bank would have to charge interest is what is known as time value of money. Time value of money. Time value of money concept simply says that the value or the worth of money is not the same all the time. It reduces over time as a result of inflation or price increases. Let's illustrate this with this hypothetical example. Assuming you have 1,000 Ghana cedis and the price per bag of cement is 100 cedis. Then with the 1,000, you'll be able to buy 10 bags of cement. And that 10 bags of cement now measures the value of the 1,000 cedis. Assuming in a month's time, the price per bag increases from 100 cedis to 120 cedis. In that case, with the 1,000, you will no longer be able to buy 10 bags, but this time you can only buy 8 bags, meaning the value of the 1,000 has reduced from 10 bags to 8. Let's also continue to make this assumption that in 6 months' time, the price per bag of cement has increased from 120 to 150. This time around, you can only buy 7 bags, meaning the value has dropped further. Now, this comes at a loss to the bank. And in order for the bank to preserve and protect the value of the money it is giving to you as loan, it has to charge some interest. Interest payment is a win-win situation because every bank has a fiduciary responsibility to protect and preserve your deposits. That is why a bank pays interest on your deposit, making sure that by the time you go for your money, the value of your deposits is protected. The quantity of goods and services you can buy will still remain the same so that it doesn't become a total loss to you. Okay? Are we on the same page? Now, the other factor that a bank will seriously consider when it comes to fixing interest rates is the element of risk. Now, risk is simply the probability of a loan being paid or not. If there is a high probability that you'll be able to pay back the loan, then a lower interest rate will be given to you to pay. On the other hand, if an assessment shows that there is a low risk there is a low probability that you will pay back that loan, then a higher interest rate will be given to you. So risk profiling of the customer and the sector is a key consideration when it comes to fixing interest rate. Now let's illustrate this with this simple example. Assuming there are 2 farmers, one is engaged in rain-fed agriculture, the other is engaged in irrigation farming. With the one who is engaged in rain-fed farming, there is a high level of uncertainty because the conditions surrounding the farming are left to nature and is not directly in control of that farmer. So the yield that will help the farmer to generate income is not guaranteed, and therefore the business is risky. In that case, the bank will give that customer a higher interest rate to pay. Considering the other farmer who is engaged in irrigation farming, the issue of uncertainty has to a very large extent addressed by the fact that irrigation can guarantee yield. So that farmer will be able to make some profit to be able to pay back the loan. In that case, a lower interest rate will be given to that farmer to pay. So that's one of the reasons why a bank will give a higher interest rate to one customer and a lower interest rate to another customer. The last but not least of the 5 factors that I want us to look at in this episode informing fixing of interest rates is what we call operational costs. Look, banks are confronted with a lot of costs. We expect our banks to give us convenience, services, and all of that. And this time around, we are moving into the technological space. This comes at great cost, okay? All the digital platforms that our banks are using to be able to give us softwares to monitor our accounts and give us text messages whenever a transaction is performed on our accounts. All are not developed by the banks. They are developed by other companies and sold to them. And it involves a lot of costs. Okay? There is also staffing costs. Any bank that wants to attract professionals and competent staff should be prepared to pay good salary and good remuneration. We also have infrastructure costs. All the beautiful edifices that we see our banks put up, offering them conducive and congenial environments, that makes us proud of our bankers, all has cost implications. They are not for free. They have to be paid for. There is also what we call compliance costs. There is insurance costs, there is auditing costs, there is training costs, and there is also taxation, among a number of costs. How else do you expect banks to be able to take care of all these costs and still make reasonable profits for those who provide capital? You know that if a bank is not able to make reasonable profit and declare dividend for those who, supply capital, that's shareholders, shares will not be bought and banks will not have enough capital to be in business. And with lack of capital, Bank of Ghana will collapse banks. We don't know what happens around 2019 and 2020. Banks lost their licenses because of inadequacy of capital. So for banks to be able to survive, they have to charge reasonable amount of interest. And these are some of the 5 factors that they consider in arriving at the interest rate that they give us to pay. Did you get value from this video? I believe that with this level of understanding, you will be able to strategically position yourself to take advantage of the banking services available to you. If this is the first time you are watching my videos, kindly consider subscribing to be part of the family. And more importantly, I would love you to leave a comment. Tell me exactly what you do not understand and want me to address, and I'll do just that. I'll see you again in yet another episode. Thanks for watching.